Okay, so last week we started, we completed discussions around capital budgeting. We started from the introduction to capital budgeting. We discussed the procedures involved in capital budgeting decision. Thereafter, we proceeded to discussing the characteristics of capital budgeting. Then next, we dissected the methods of project evaluation, including the net present value, internal rate of return, modified internal rate of return, project duration, discounted payback period, the normal payback period, as well as the accounting rate of return. After the discussion of uh, relevant techniques, then we move to discussing relevant cash flow, how to identify relevant cash flow. We talked about variable costs, fixed costs, incremental, attributable, specific, direct fixed costs. We also talk about sunk costs, opportunity costs, how to treat depreciation, amortization, or provision when you see it in a question. Not only that, we also talk about interest, okay? We talk about interest. Should you include interest or you ignore it when you see it in a question? We discuss that. Then, finally, under the relevant cash flow, we also talk about working capital. And I told you that we have a one-off working capital. We also have incremental working capital and how to treat each of them when you see it in a question. When we finish that, then we'll move to discussing the impact of inflation and taxation in capital investment. And I provided you with a columnar format that you can use to calculate net present value when you see it in a question. And that's where we stopped last week. All relevant discussions, all relevant concepts in relation to capital budgeting have been discussed. Okay, today what we want to do is to talk about is to start illustrations. We want to start illustrations relating to capital budgeting decision. So we have 2 more periods to go. All right, we have 2 more periods to go. Today, if we're able to solve like 2 different illustrations, then in our next class, we should add additional 2 questions, and then that means we are fine with capital budgeting. All right, so let's move on. Let me see, which question are we going to start with today? Let's see. I need you to open the material at your end so that we follow through together. Let me see. Yes, let's start with this illustration number 2. Let's start with this. Let's have a general question on how to calculate how to calculate NPV, internal rate of return, payback period. I will include accounting rate of return, so that's just to refresh your memory as far as what we have done so far is concerned. And not only that, especially at this level, examiner can just give you, because you are just upcoming financial manager, you are upcoming. The kind of question you are going to get at this level may be different from professional level. However, so we need to, this area of NPV, IRR, payback period, accounting rate of return may be tested more at this level relative to strategic financial management at professional level. So let's refresh our memory on what we did, on what we discussed under discounted and then non-discounted cash flow method. I need one of you to read illustration number 2, Orimolade Nigeria Limited. Who is helping us to read? Yes, who will take the lead? Who is there to help us to read?
I read.
Okay,
Oh, okay.
thank you. Yes. Who is taking the lead? Chidima, you want to try?
Yes, I want to.
All right, go ahead.
Illustration. Orimolade Nigeria Limited is currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of new plants. The company made available the following data for each project. Orimolade Nigeria Limited has an estimated cost of capital of 10% and employs the straight line method of depreciation for all fixed assets when calculating net profit. Neither project would increase the working capital of the company. The company has sufficient funds to meet all capital expenditure requirements required. Calculate for each project the net present value, the approximate internal rate of return, the payback period. B. States which, if any, of the two investment projects the company should accept and why.
Thank you very much. Yes, that is the requirement. The first requirement says we should calculate NPV, approximate internal rate of return, and then the payback period. So we want to calculate NPV. Remember my explanation. For all the techniques, you are going to need cash flow to calculate NPV, IRR, payback period, modified internal rate of return, discounted payback period, project duration, all of those techniques you are going to need cash flow to calculate them. However, only the accounting rate of return uses accounting information. Only accounting rate of return uses accounting profit or loss. Okay, so in this particular question, examiner has hidden something. Pay attention to what I'm about to say. Examiner has hidden something such that if you are not careful, you will rush the question because the requirement is simple, straightforward. Almost everybody can calculate NPV, IRR, payback period, accounting rate. So everybody can calculate it. So because you see the requirement, oh, this is very straightforward, you rush it. If you don't pay particular attention to the information given to you in the question, the same way you rush out is the same way you are going to rush out. I mean, rushing is the same way you are going to rush out. What do I mean by that? If you your mind will not be there in this question because you are eager to serve without paying particular attention to the information given to you. In this question, the examiner did not give you cash flow. You are given expected annual net profit or loss. Net profit or loss is different from cash flow. So for you to be able to calculate net present value, internal rate of return, payback period, you must convert this cash flow, you must convert this net profit or loss, you must convert it to cash flow. And that's why when you look at that requirement, examiner did not ask you to calculate accounting rate of return because it will be too cheap for you to do, and that's why they did not mention that you should calculate accounting rate of return. So you have to shine your eye. You need cash flow to calculate NPV, internal rate of return, and then payback period. But in this question, examiner did not give you NPV. You are given expected annual net profit or loss. You don't use profit or loss to calculate NPV, internal rate of return, or payback period. So we need to convert this profits or loss to cash flow. All right. So that is what is hidden in this question. But because you are eager as a student, oh, this is cheap, 15 marks, 20 marks, let me rush it and pocket it. The same way you rush it is the same way you are going to. In fact, you won't be able to rush out because you wouldn't know. You wouldn't know whether you are right or wrong. You would think that you are doing the right thing, not knowing that you are using the wrong information. Okay, so that is as per that. Let's solve the question now. Let's solve. Let me switch to the working note. Okay. Yes. So the first thing you are going to do is you want to calculate net present value. remember, these are two mutually exclusive projects. So you calculate for project A and B. So, but on the day of your exam, you need to estimate how many pages will take you to do the normal calculation. We want to calculate NPV for two projects. So this first page will be for NPV. Second page will be for payback period. The third page will be for internal rate of return. And as I said, I've also included accounting rate of return. Let's say the fourth page will be for accounting rate of return. I would then start my working from the fifth page. So I come here, working. So first thing first, like I said, you need to calculate cash flow because accounting profit is given to you, so you must convert that profit to cash flow. So before you calculate, remember to get your cash flow is equal to profit or loss plus depreciation. To convert profit to cash flow. To convert profit to cash flow, it is profit or loss plus depreciation that will give you the cash flow. So you are going to do for project A and then project B. So what that simply means is that I cannot start my working with cash flow. I need to go and calculate depreciation first. Profit or loss is given in the question. So I need annual depreciation. So annual depreciation, it will be calculated as, depreciation will be calculated as the cost, okay, the cost minus scrap value, cost of each project minus scrap value divided by the useful life. Okay, so this will give annual depreciation. So in this case, I would then say for project A, depreciation for project A would then be equal to, let me do it this way, equal to, what's the cost of project A? Give me the number, please, so that I don't need to be switching from pages. Chidima, I need you to be my partner on this question. So you'll be giving me the information that I need. What's the initial outlay of project A?
200,000.
200,000 is the cost of project A. Minus, what's the scrap value of project A? Yes? Chidima, are you still there?
14,000.
Please, you have to be fast. 14,000 is the initial outlay, 14,000 divided by useful life of project A, I think it's 3 years. So 186,000 divided by 3. What do I have there? 186 divided,
14,000.
that's 62,000. Annual depreciation is 62,000 per annum. Okay, then we do for project B. The cost of project B is how much?
120,000.
120,000 minus scrap value,
Scrap value. 12,000.
12,000. Useful life is also 3 years.
Yeah.
So what do you have there?
36,000.
So 36,000 naira per annum is the annual depreciation for project B. So now that we have computed annual depreciation, I can then proceed to calculating the cash flow, annual cash flows. So let me say this is depreciation. Let me call it annual depreciation. That's working number one. Then working number two now, cash flow. Annual cash flow. To get the annual cash flow, we have said that cash flow is equal to profits or loss
plus depreciation.
plus depreciation. So because we have profits or loss for year one to year three, so we're going to use table to get our cash flow. Therefore, I will create a column for year. I will create another column for profits or loss. I will create a column for annual depreciation. Then I will create a column for cash flow that we are looking for. Okay. So starting from year one, year two, year three, because the useful life of this project is 3 years. Okay. So give me the profits or loss for projects A.
For year one, we have 58,000.
58,000 profits.
For year two, we made a loss of 2,000.
2,000 naira loss.
Then for year three, we have 4,000 naira.
4,000 naira profit of year three. Then annual depreciation for project A, we calculated 62,000.
2,000.
So to get cash flow, we said cash flow is profit or loss plus depreciation. 58,000 plus 62,000 will give us 120,000. 2,000 naira loss plus 62,000 naira will give us 60,000 naira cash flow. 4,000 plus 62,000 will give us 66.
66,000.
So we have calculated cash flow for project A. Let's do for project B. So here, profits or loss, annual depreciation, then cash flow that we are looking for. Year one, year two, then year three. Give me the profit or loss for project B.
36,000 for year one.
46,000.
36,000.
336.
Yes.
Year two.
Made a loss of 4,000.
4,000 naira loss. Year three.
8,000.
Profit of 8,000. Annual depreciation is 36,000. So we had 72,000 cash flow for year one, 32,000 cash flow for year two, then
And
44,000
44,000.
cash flow for year three. So you can see now that we have converted the accounting profit or loss to cash flow, we can then proceed to calculating the NPV, internal rate of return, and then the payback period. So yes, you may need to call these numbers for me, the cash flows. So let's go ahead and calculate our net present value. Okay. So I will then say net present value. Of course, the name of the company is Orimolade
Yes.
Nigeria Limited. Okay, that's the solution to illustration number What illustration is that? Illustration number 2. Illustration 2. Page, that's page 62. Page 62. Okay. All right then. So I want to calculate. I will then say A, Roman figure 1, calculating NPV. Now that we have completed our workings, life will be so easy to do our calculation. So for project A, remember, we have mutually exclusive projects. So you are going to do for each of them. In this case, you have to be moving faster on the day of your exam. So to get the NPV, I'll create a column for year, description of item, cash flow, discount factor. What's the cost of capital given in the question? I guess it's 10%.
10%.
10%.
10%.
Okay, 10%. All right. So for year 0, year 1, year 2, year 3, initial outlay will be in year 0. Initial outlay for project A is 200,000 naira. Here will be 200,000. The cash flow we computed for project A for year 1. What's the cash flow for year 1? I calculated 120, right? Because I don't want to be switching
Yes,
pages.
120,000.
That's why I say you should record the numbers for me. 120,000. What's
Yes.
cash flow of year 2?
50,000.
50.
60.
60,000. Cash flow of year 3.
66,000.
Now, when you look at that year 3, we also have scrap value, isn't it?
Yes.
We have scrap value of 14,000 naira. So since the cash flow of year 3 of 60,000 and the scrap value of 14,000 naira will be affected with the same discount factor, so we can merge it together. Okay, so in year 3 we are going to have cash flow plus scrap value. We have cash flow of 66,000, scrap value of 14,000. The addition of the two is 80,000. Therefore, discount factor at 10% for year 0 is 1. Year 1 is 0.909. Year 2 is 0.826. Year 3 is 0.751. So let's multiply to get the present value. So what do you have? Year 1 present value. Yes.
109.
109 what?
080.
080.
109,080. Then year 2 present value.
49560.
49560. Year 3.
60,080.
60,000.
And 80.
And 80.
So now you recall that we said NPV is the difference between the present value of cash inflow and present value of cash outflow in capital investments. So in this case, you are supposed to add up the PV of the positive present value first before you net off the negative present value. So what's your final answer? Yes.
18,720.
18,000,
218,720.
720. So that's the
Wow.
NPV for project A. You then do for project B.
Okay.
Yeah, 0, 1, 2, 3. All right. NPV. So we have the year. Item. Cash flow. Then we have discount factor at 10%. Okay. Initial outlay, cash flow plus spare value. So initial outlay of project B is what?
120,000.
120,000. We calculated cash flow for project B. What's the cash flow of project B for year 1?
72,000.
72,000. Year 2?
32,000.
Year 3?
44,000.
So in that year 3, we also have scrap value for project B. Scrap value of
12,000.
project is 12,000. So
Yes.
12,000 plus 44,000, that's 56, right?
56,000. Yes.
So in year 6, we are going to have 56,000 naira cash flow. All right. There will
Yes.
be 120,000. So 0.909,826,751. So let's multiply.
65,448.
65,
448.
448. Year 2,
26,432.
432. Year 3,
42,056.
42,056. So let's get the NPV. 42,056 plus 36,432 plus 65,448 equal minus 120 equal. What do you have?
13,936.
23.
You say it's what? 13,936.
936.
Okay, so that's our NPV. That's our NPV. So that's that. We are done with NPV. Examiner says you should calculate NPV, approximate internal rate of return, and then pay back period. So let's calculate. The next thing we want to do now, number 2, A2, is to calculate internal rate of return. So I will then say calculating
Can I ask you a
internal.
question, please?
Who is speaking?
It's Chidima.
Yeah, go ahead with your question, Chi.
Okay, the discounted factor. I don't know how you got those values. Sorry, my network threw me out.
You know, we did this under cost of capital. All right, so it is assumed that you know it. Discount factor, let me find somewhere to put it. Let me just look for, let me use this small space. Now, discount factor is calculated as 1 plus R raised to power minus N. So in this case, since our cost of capital is 10%, so that will be 1.10 raised to power minus 1, for example. So this will give you 0.909. Okay? Chidima.
Thank you.
Yeah. So let's calculate internal rate of return. When I was explaining the concept, we said that internal rate of return is also known as break-even rate of return, yield to maturity, market discount rate, or nominal discount rate. So it's the internal rate of return is the rate of return that equates the present value of future cash flows to zero. Any rate that you assume that produce zero NPV is the internal rate of return. And I told you that whenever you want to calculate internal rate of return, you are going to carry out 3 steps. Step 1, you are going to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you positive NPV, another discount rate will give you a negative NPV. Then step 2, you calculate internal rate of return using IRR formula. Then step 3, you advise whether the project is financially viable. These are the 3 procedures you are supposed to carry out anytime you want to calculate internal rate of return. So with this, the first thing you want to do now is to assume 2 discount rates that will produce 2 opposing NPV. Before that, Kemi is asking a question. Talk to me, Kemi.
Thank you, sir. Please, is it possible we have working capital when I'm calculating NPV? And if it is possible, how are we going to treat it?
Were you in the class last week?
No,
Kemi,
sir. Though I've watched the...
you,
Yes, sir. I was not in the class.
so when we get to where the question you have working capital, you see the way we are going to treat it. I explained it last week how to treat working capital. All right. So just hold on. When we get to illustration where we have working capital, you will see it. All right. So we want to assume 2 discount rates that will produce 2 opposing NPV. Pay attention. Before you assume your discount rates, you have to check the size of your cash inflow and the size of your cash outflow. Pay attention. I repeat, whenever you want to assume discount rates when calculating internal rate of return, you have to check out the size of your cash inflow and the size of your cash outflow. When you look at project A, for example, the cash inflow, the positive cash flow for project A, year 1 is 120,000, year 2 is 60,000, year 3 is 66,000 plus scrap value of 14,000, making 80,000. By the time you add up 3 figures together, that's about 260,000. That's almost 1.5 over 150% of the initial outlay. All right, of the initial outlay of 200, it's almost double. All right, the cash inflow is almost double the cash outflow. Therefore, the discount rate you are going to assume should be a little bit higher. In this case, if you assume 5%, you just be having positive. Even if you do 10%, it should be positive, because when you look at the size of your cash inflow, this is about 260,000. Cash outflow is 200,000. So let's start with something like 15%. If 15% is positive, we can increase to 20%. But if 15% is negative, we can reduce it to 10%. So that's the way to go. Quickly, let's start with 15% for our internal rate of return. So I will say assume 15%. So we are going to use this 15% to calculate this. Can this place occupy? Yes. So let's say this is year 0, year 1, year 2, and then year 3. Okay. Now we are going to use one table to calculate our internal rate of return. And this should be the approach you adopt on the day of your exam, because it will make life easy for you and it will be faster. Okay, so we have description of items, we have cash flow, we have discount factor, then we have present value. All right. I still need the space. Let me do it this way. I will manage it. Not yet. This guy is supposed to be divided into 2. This one 2, divided into 2. All right. So we are starting with 10%. Let me do it this way. Okay. This is for year 0. That's too close. Year 1. Okay. That's manageable. All right. So this is at 10%. Year 0, 1, 2, 3. Okay. So cash flow. So this is initial outlay. Cash flow, then cash flow plus fair value. In year 0, initial outlay is 200,000 for projects. We're starting from project A. So here is 200,000. Then year 1 cash inflow for project A is 120,000. Here is 120,000, 60,000, then 80,000. Discount factor, sorry, this is 15%, not 10. So somebody should give me discount factor for year 1 at 15%. Yes. 1.15 raised to power 1 minus. That's 0.87. 0.870. Then for year 2, 1.15 raised to power 2 minus equal 0.756. Then year 3, 1.15 raised to power 3 minus equal 0.658. 658. Therefore, I need to get the present value. Here is 200,000. Okay, so 120,000 multiplied by 0.87. 104,400. 104,400. Then year 2.
45,360.
45,360. Year 3.
52,640.
52,640. Therefore, 52,640 plus 45,360 plus 104,400 equal minus 200. What's the final answer?
2,400 negative.
2,400 negative. Okay,
Yes,
are you
sir.
sure it's negative or positive?
It's negative.
It's positive.
It's
Be careful.
It's
that means
positive.
you are starting from two. If you start from the negative, you are going to misinterpret it. That's why I say you should always start from the positive present value. All right. So it's positive.
Positive, yes.
So let's move to, we assume 15%. We got a positive NPV of 2,400. Let's assume a higher discount rate, okay, to get a negative NPV. When you look at the NPV that we calculated, which gave us 2,400, you will notice that 2,400 is closer to zero. It's very close to zero. So what I mean is that, of course, we assume 15%, we got a positive NPV of 2,400. Let's assume a higher discount rate that will give us a negative NPV. So let's assume 20%. Let's assume 20% and see what we are going to get. So what do you have? What's the discount factor for year one at 20%? 1.2 raised to power minus 1.
0.833.
0.833. Then year two,
0.294.
I can't see that. I can't hear you properly. You say
0.694. 694.
694. Okay, year three,
0.579 approximately.
0.57.
579. So let's get the present value. Here will be 200,000. So you have to be very careful. If you are using one table for your internal rate of return, you have to be very careful so that you don't give what belongs to Peter to Paul. It's like there's likelihood for you to make mistakes. So be careful. So you are picking the cash flow, multiply with the second discount factor. So 120,000 multiplied by 0.833.
99960.
99.
960.
990.
Is it 960 or 560?
960.
999.
960.
Okay. Then for year two present value, what do you have?
41640.
41640.
Yeah.
Year three,
46320.
46320.
0.
So let's add up all the positive present values. All the positive present value, let's add them together. Minus 200,000. Final answer, what you get?
12,080.
12,080. Positive or negative?
It's negative.
Okay. So we assume 15%. We got a positive NPV of 2,400. Because we are looking for a negative NPV, we then increased to 20% and we got negative NPV of 12,080. Now that you have two opposing NPV, we can then calculate internal rate of return. I would then say IRR is equal to lower discount rate plus the NPV of the lower discount rate divided by NPV of the lower discount rate plus NPV of the higher discount rate. So higher discount rates minus lower discount rates. That's the formula for internal rate of return as we did under cost of capital. Therefore, IRR for project A is equal to, we assume 15 and 20%. 15% is lower. So here will be 15 plus NPV of that 15% is 2,400 divided by 2,400 plus the NPV of higher discount rate, 12,080. That's Yes, 12,080. So higher discount rate is 20, lower discount rate is 15. From your calculator, this is what you are going to do. You start from the denominator, all right? So 2,400 plus 12,080 equal to 14,480. You then say 2,400 divided by 14,080. Is it 14,080 or 14,480?
14,080.
14,480.
Is it 14,480?
14,480.
Okay.
It's
14,480.
480.
Okay, 14,480 equal. Then what you have in your calculator multiply by difference between 20 and 15, which is 5. Multiply by 5, then plus 15 equal. That's 15.83%. So internal rate of return is equal to 15.83%. You restrict your number because you have two mutually exclusive projects. So you restrict your number to 2 decimal points. Okay, so this is the internal rate of return for project A. I will also do for project B. The same way we calculated for project A is the same way we are going to do for project B. Okay. Yeah, 0, 1, 2, 3. All right. Okay. So that will be the NPV. Now, for project B, initial outlay is 120,000 naira. Cash flow. The cash inflow of project B for year 1, we calculated 120, no, we got 72,000. That's the cash inflow. 72,000.
32,000.
Year 2, 32.
Year 3,
And then
44,000.
plus 12,000, that's 56,000. Okay, so we're assuming 15%. We also assume 20%. So 15%, 20%. Now, here will be 1. Here is also 1. 120,000. 120,000. We calculated discount factor for year 1 to be 0.870 at 15%. Year 2 is 0.756. And then year 3 is 658. 0.658. 0.658. At 20%, we calculated 0.833. 0.833. For year 2, at 20%, 0.694. 0.694. 0.593. Is it 593 or 594? 579. 579. Okay, so let's get the present value for year 1 cash flow at 15%. So 72,000 multiply
62.
by 62 what?
62, 640.
640. Year 2, 32,000 multiplied by
24,
0.75,
192.
24,
24, 192.
192. Year 3,
36, 848.
36,848. Okay, so let's get the present, the NPV. Yes, the NPV.
59,976.
59.
Yes, 976.
Lila. It can be
3680.
3,000.
680.
680.
680 positive, right?
Yes.
Yes.
So now at 20%, what do you have? What's your present value for year 1 at 20%?
59,976.
You said 59,
976.
976.
976, 59, 976. Year 2,
16789.
year 2 is what?
22,208.
22,208. So add it up.
Negative 5392.
53,
53992. Negative.
5392 negative. So that's it. So that's, we assume 15%, we got a positive NPV of 3680. Then we increase to 20%, we got a negative NPV of 5392 for project B. Now that you have two opposing NPV, we can then proceed to calculate internal rate of return for project B. Therefore, IRR equal to lower discount rate of 15 plus NPV of the 15% is 36 divided by 3680 plus NPV of the higher discount rates 5392 multiplied by difference between 20 and 15, which is 5. So internal rate of return for project B is what? 3680 plus 5392. Okay. Then 3680 divided by answer, multiplied by 5 plus 15. Give it to me. What you get?
17.
Pardon?
17.03.
17.03%.
17.03.
So if we are to choose between project A and B, of course, project B is higher. Therefore, project B should be selected. But examiner did not ask you to make a decision. So that's that. Then number 3 requirements. Requirement number A3, you have to calculate payback period. So, high. Calculating payback period. Okay. We said that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow. We said payback period is a measure of liquidity. That is, how quick can a project pay back the amount invested? How quick or how soon can a company recover the amount invested in a project. So to calculate payback period, I gave you two different ways, two different methods, depending on whether you are given constant cash inflow or irregular cash inflow. As far as this question is concerned, we have irregular cash inflow. Therefore, we are going to use the tabular method to calculate the payback period. So for project A, we create a column for year, description of item, cash flow, then cumulative balance. Cumulative balance. Year 0, 1, 2, 3. Please, when you are calculating your payback period, don't add scrap value to the scrap value to the cash flow of the final year. So you separate it, because once you do that, that means you want to use scrap value as a bailout. So don't do that. You separate it. You separate it. So I would then come here. Here is initial outlay, cash flow, cash flow, cash flow, then scrap value. For project A, cash flow for year 0 is 200,000. That's the initial outlay. So cash inflow generated for year 1 is 120,000. Okay. Then for year 2, Joseph, please mute. Joseph, then Victor, please, all of you mute. All right. Then cash flow for year 2, we calculated 60,000 and then 66,000. 60, 66,000. Then scrap value for project A is 14,000. Now, we want to recover this 200,000. We want to know, when is the company going to recover this 200,000 naira invested? So starting from year 0, 200,000 minus 120,000 will give us balance of 80,000 at the end of year 1. 80,000 minus 60,000 will give you a balance of 20,000 at the end of year 2. All right. The outstanding balance of 20,000 naira is less than the next cash inflow of 66,000. Therefore, you put a dash and you calculate the payback period. In this, I will say payback period equal to, we have recovered for how many years? Year 1, then year 2, 2 years. So here will be 2 plus the outstanding balance of 20,000 divided by the next cash inflow of 66,000. So what you have? 20 divided by 66 plus 2. 20 divided by 66 equal
2.3.
plus 2.
2.3.
That's
2.3.
2.30. So here is 2.30 years. Remember, you must express your answer in years. Okay, your answer must be in years, because you have said that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. So that's payback period for project A. I will then do for project B. Okay, yeah, item, cash flow. Let me write it out in full. Then cumulative balance, yeah, 0, 1, 2, 3, 3. Initial outlay, cash flow, scrap value. For project B, we are investing 120,000 naira. Year one cash inflow for project B is 72, 32, 44. 72,000, 32,000, 44,000. The scrap value of project B is 12,000. So in year zero, the cumulative balance is 120. 120 minus 42 will give us 48,000, right?
Yes.
So at the end of year one, we have recovered 72,000 naira. We have a balance of 48,000 naira to recover. 48,000 minus 32,000 will give us
16,000.
16,000. Okay. So at the end of year two, we have recovered 104,000 naira out of 120. We have a balance of 16,000 naira to recover. 16,000 naira outstanding balance is less than the next cash inflow of 44,000. You put a dash and you calculate the payback period. So in this case, I would then say payback period is equal to, we have recovered for 2 years plus outstanding balance of 16,000 divided by next cash inflow of 44,000. What you get? That's
2.4. 2.4.
In 2 decimal place. 2.3.
2.36 years.
6 years. Okay. So you can see it's good to put it in 2 decimal places, because when you look at the first one, even though the first one is 2.30, all right, this one is also 2.36. Okay, so this is what examiner asks you, and that's what we have done. So, but I now said, let's include accounting rate of return. Let's include accounting rate of return. There is no space again. So let me go down there and put it there. Let's calculate accounting rate of return. Number 4. This one is not part of the question. I'm the one that included it. So calculating accounting rate of return. ARR. And I explained to you that ARR is a measure of profitability. It is calculated by using accounting profit or accounting information. You need accounting profit or loss to calculate the accounting rate of return. So which means if cash flow is given to you, you convert it to accounting profit or loss before calculating the accounting rate of return. But this particular question, examiner has given you accounting profit or loss, so there's no need for you to convert cash flow again. All right, so and that's why the examiner did not ask you in the question to calculate accounting rate of return. So to do this, I will say accounting rate of return is calculated as average annual profits, AAP, over average investments. Average investments, AI, all multiplied by 100 over 1. So for us to be able to do this, we are going to calculate average annual profit first. We calculate average investment second. Then we now calculate accounting rate of return. Since we've already calculated depreciation, so we don't need to stress ourselves. So I want to calculate average annual profits. Average annual profits. So let's start with project A. on the day of your exam, there's no need for you to be stressing yourself. All you need to do is to add up the profits. Add up the profit or loss, you divide it by a number of years, which is 3 years. It will give you the average. So no need for you to be stressing yourself. All right? So in fact, let me show you. This is what I mean. Average annual profits, AAP. AAP is equal to total profits divided by the useful life. So for projects A. So I will then go back to the question. What's the profit of project A in the first year? Profit of project A is 58,000. Here is 58,000. We have a loss of 2,000 for second year, then plus a profit of 4,000 naira in the third year. Profit of 4,000 naira in the third year. So we had the three of them together, then we divide it by 3. Okay? 58 minus 2,000 will give us 56. 56 plus 4,000 will give us 60,000. 60,000 divided by 3 will give us 20,000 naira per annum.
20,000.
So here is 20,000 naira per annum. Then for project B, the first year profit of project B is 36,000. Here is 36,000 minus a loss of 4,000 naira plus a profit of 8,000 naira. So this will give us
40,000.
40,000 naira, then you divide it by 3.
13.33.
13,333 per annum. Okay, so that's the average annual profits for project A. So instead of me to use table, that you can only use table. Table will be better if you have cash flow. If you want to convert cash flow to accounting profit, but since you already have the accounting profit, no need to use the table. Do it the way I've done it. Now we have just done average annual profit. Let's do average investments. So average investments. Okay. AI. So AI is calculated as the cost of the project plus the scrap value divided by 2. So I do for project A. Cost of project A is 200,000 naira plus scrap value of project A, 14,000 naira, then divided by 2. 214 divided by 2 will give us 107,000 naira. Okay, that's the average investment of project A. Then for project B, the initial cost of project B is 120,000. We have a scrap value of 12,000. That's 132,000 divided by 2. That's 66,000. That's average investment. So we have calculated average annual profits. We've also calculated average investments. We can then proceed to calculate the accounting rate of return. Accounting rate of return. So for project A, accounting rate of return for project A, we said accounting rate of return is average annual profits divided by average investments. Average annual profit of project A is 20,000 naira. Here is 20,000. Average investment of project A is 107,000. Multiply by 100 over 1. Give it to me. What do you have?
18.7.
2 decimal place.
18.69.
18.69%. Your figure must be, your final answer must be in percentage. Then, of course, this is project A. For project B, average annual profit of project B is 13,333. 13,333 divided by average investment of 66,000. Multiply by 100 over 1. What do you have?
20.20.
20.20%. So that's that. So we have calculated net present value, internal rate of return, payback period, and then accounting rate of return. So to make your job look better, you can put everything in a summary of table. Okay? Summary, you can say summary of results. Anytime you have calculated or you have appraised a project using more than one techniques, it's better you put your answer, your final answer in a table. That will enhance your presentation. So let's have the methods here. On the column are the methods. Under the methods, we use NPV. We have payback, we have internal rate of return, payback period, then we have accounting rate of return. Okay. Then, of course, we calculated we have two different projects. Let's say project A, project B. Then we have ranking. We are going to have ranking and selection. Ranking and selection. Let me push this one a little bit to the front. Okay. NPV. So that's it. Let's put the figures we have calculated inside each of them. For NPV for project A, NPV of project A, we got 2,400. Project B NPV, what we got what? From our calculation, NPV of project B.
NPV of project A is 18,720.
Sorry, 18,720. Then project B is 13,936. So here is 18,720. 13,9. Is it 956 or 936?
936.
936. So on the basis, if you want to
936.
if you want to select on the basis of NPV, which of the two projects are you going to select? Between project A and B, which one are you going to select?
Project A.
Project A.
Project A produce a higher positive NPV.
NPV.
Then, on the basis of offer, what's our internal rate of return for project A? We calculated 15 point something.
15.83.
15.83%.
17.03% for B.
17.03%.
Thanks.
So on the basis of internal rate of return, which of project A or B are we supposed to select?
Project B.
Project B, because project B produced a higher internal rate of return relative to the company's cost of capital of 10%. Okay, then for payback period, we calculated payback period of 2.3 years. For project A, then 2.36 years for project B. So on the basis of payback period, which of project A or B are we supposed to select?
Project A.
Project A produced a lower or a shorter payback period. Then accounting rate of return, we calculated 18.69 for A, 18.69%, then 20.20%. On the basis of accounting rate of return, which of project A and or B are we supposed to select?
Project B.
Project B produced a higher accounting rate of return. Yes, Grace, talk to me.
Good evening, sir. No,
Good evening.
it's not about this one. So to convert profit or loss to cash flow, I know you said that is the profit plus depreciation.
Yes,
Then
profit or loss plus depreciation.
so what if I want to convert cash flow to depreciation? Would it be
You want to convert cash flow to depreciation?
cash flow to profit?
It will
Would
be
it
cash
be
flow minus depreciation.
okay, sir?
Yeah. Okay, so in number B, part of the question, the examiner is now asking you to advise. Number B states, which, if any, of the two investment projects the company should accept and why? And that's one of the reasons why this summary of table will come in handy. This will enhance because you can see the final result. You can see the summary of the final result. Now, examiner is asking you in the B part of the question, which of project A or B should the company select? Yes? Tell me. If you know it, raise your hand. If you know the final answer, raise your hand. Which of project A or B should the company select? You know, these are mutually exclusive. The company, Orimolade Nigeria Limited, cannot accept project A and B. It has to be one of the two. So which of project A or B do you think the company should accept or undertake? If you know it, raise your hand. What happened now? All of you have been talking since now. Now it's time for you to make a decision. You don't want to take the lead. No worry, I will call one of you now. If you like, disappear or don't answer. Andrew, I've not heard your voice. Andrew, yes, tell me. Andrew, Abba. Yes, which of the project A or B
sir,
should the company
for me,
select and why?
will choose project A because it has the highest net present value, and like you said, if the net present value or is the best
Investment
is the best
appraiser.
Yes, the best investment appraiser method. So anyone that has the highest net present value should be considered first.
Yes.
So I'll be going with project A.
You are correct, Andrew. You are a fast learner. You are a fast learner. So that's what I said. The rule is that when selecting, when ranking between mutually exclusive projects, decision should be based on NPV because NPV is a technique that is consistent with the shareholders' wealth maximization objective and is also an absolute measure of profitability. You can see in error terms, we can see here that project A produced a higher positive NPV of 18,720 relative to project B with a positive NPV of 13,936. So your decision should be based on the name present value. So I will come here, advice. Because according to that number B requirement, you have to state which of the two investment projects the company should accept and why. So in this case, I would then say project A produce a positive NPV of 18,327.20. Why project B generated a positive NPV of 13,936. So you then say project A with a higher positive NPV relative to project B should be selected. This is because examiner say why. So you need to include the reason why. So this is because the NPV is a technique that is consistent or in consonance that is consistent with the shareholders' worth. Or put it this way first. This is because NPV is a technique or NPV is a measure of absolute. Okay, since I've already listened, let me reframe it. The NPV is a technique that is consistent with the shareholders, worth maximization objective. Okay, and it's a measure of absolute profitability. And is a measure of absolute profitability. Therefore, the net present value is the most appropriate, is the most suitable in the ranking of mutually exclusive projects. Okay, is the most suitable in the ranking of mutually exclusive projects. That's all. No need to talk too much. That's all. With this, I can hear my full marks. I can hear my full marks. So that's end of the question. Let me know if you have any question for me so that we can move to another illustration. All right. Any question? If not, I will switch to the study pack so that we can have another illustration. We have 3 more illustrations to go, so we should be able to complete one today. Another one next time by the grace of God. Okay, so in the absence of no question, let's switch to the question material. Let's have one more illustration today. Let me see. We are going to solve one question that involves project specific. Okay. Okay. The first thing first. Let's solve this illustration number 5. Let's solve illustration number 5. Okay. Who is helping us? Who will help us to read illustration number 5? Yes?
Let me read again.
Okay, Chidima, go ahead. Thank you.
Washington PLC is considering a project whether or not to commercialize an innovative muscle toning device, MTD, that will be used in the treatment of sporting injuries. It is expected that commercial life of the MTD will be 4 years, after which technological advances will bring more sophisticated devices to the market, and the sales of MTD will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. Initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. Information on future returns from the investment has been forecast to be as follows. Selling price inflation rate and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device would cost 220 million naira, and an additional initial investment of 20 million naira would be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million naira. When the production and sales cease, the average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. Capital allowances, tax allowable depreciation of 25% on a reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance would be claimed in the 4th year of operation. Washington PLC has a real cost of capital of 7.8%. You are required to calculate NPV, IRR, and discounted payback period. On the basis of NPV, advise if the project should be considered. What are your assumptions on the calculation above? This question is too long.
Thank you very much, Chidima. Yes, that is the question the examiner is asking you to calculate NPV, internal rate of return, and then discounted payback period. This is loaded. You have, and the beauty about this is that it's just an independent project, so not mutually exclusive. It should be faster. However, when Chidima was reading the question, you can see that you can hear her mentioning depreciation, tax allowable depreciation. That means we are going to calculate capital allowance. Not only that, she also mentioned general, you are given inflation rate. So that means there will be inflation in our calculation. We also have working capital in the question. We have selling price. That means we are going to have sales value. We have variable cost. We have fixed cost. So this is multiple. We are given multiple variables. As a result, we are going to use columnar formats to calculate our NPV, internal rate of return, and then discounted payback period. So if that is the case, let's start. We want to calculate NPV. First thing first, pay attention, please. Whenever you are given a question like this, the first thing you need to do is you need to carry out your workings. You are given selling price, you are given variable cost, you are given fixed cost in current price terms. So you need to go back to the question and check if you are given inflation. Yes, we are given inflation for each of the variables. So what we need to do, first thing first, you inflate your selling price. After inflating the selling price, you multiply with number of units sold. After doing that, then you get your sales value. Once you have your sales value, you go and post. You move to the next one. Variable cost is given to us in the question. Am I given inflation rate on variable cost? Yes, there is inflation rate on variable cost. Therefore, you inflate the variable cost for each year, then you multiply with number of units produced. After that, you get your total variable cost. Then you go and post. You less it from sales. Then you go back to the question. In this particular question, you are given fixed cost in current price terms. The fact that you are given fixed cost in current value in current price terms does not mean that it is relevant. I told you when I was explaining last week that there are 3 ways examiner can test you on fixed cost. If you are given fixed cost, no additional information, that fixed cost is not relevant. Not only that, if you are given fixed cost including depreciation, I also said the fixed cost is not relevant, but examiner wants you to do something. What are you supposed to do? You go and calculate annual depreciation. You less from the fixed cost. Whatever you have thereafter is relevant. Then not only that, the third one is if you are given you have given fixed cost that exclude depreciation. I said fixed cost that exclude depreciation is relevant. You must consider it. So you have to go to the question and be asking pertinent questions. So you ask the question for you to be able to get the variables that you are looking for. So without wasting more time, I will stop sharing this and move to the working notes so that within the next few minutes, we are done with our calculations. So let's calculate, we want to calculate NPV first. So solution to illustration. Illustration, what is that? Illustration 5, page 64. Solution to illustration number 5, page 64. The name of the company is Washington PLC. So, examiner is asking you in the requirement number A. So I will say requirement number A1. Requirement number A1, A Roman figure 1. So you want to calculate NPV. So calculating net present value, NPV. Let's restrict our numbers to, let me see, the figures given to us in the question. They are in millions, okay? Our figures are in millions. So if that is a fixed cost, for example, is a million. So we can restrict our number to millions or we do thousands. Whichever one you do, just know what you are doing. So we can maintain millions. All right. So like I said, when you are calculating your NPV, you are going to use columnar format because in this question, we have multiple variables. I will then go back to the question, what's the useful life of the project? According to the question, we are told that the project has a commercial life of the it is expected that the commercial life of the MTD will be 4 years. So the useful life of the project is 4 years. It's even given in the table, year 1 to 4. Now, before I put down any figures in that table, I need to go straight to where I have information on taxation. Let's go to where we have information on taxation. Examiner has told you that tax allowable, tax capital allowance, that is tax allowable depreciation of 25% on reducing balance basis, to be claimed on the cost of the equipment. Profit tax of 30% per year will be payable 1 year in arrears. So tax liability is paid 1 year in arrears, meaning after 1 year, that is after 12 months. So the profit of year 1 will be taxed in year 2. Profit of year 2 will be taxed in year 3. Profit of year 3 will be taxed in year 4, and profit of year 4 will be taxed in year 5. So as a result, this will extend by 1 more year. Therefore, here will be year 0. I will have year 1, year 2, year 3, year 4, and then year 5. I can create a column for workings. I'm teaching you exam method. All right. So I'm starting from the format I gave to you last week. The first item is sales value. So this page will be for the NPV. The second page will be for internal rate of return, as well as a discounted payback period. Then our workings, our workings start from the 4th page. So let's start working from here, because you are not expected to mix working with your main calculation. Your main calculation should come on the first page, on the main page of your answer booklet. Then workings will come last. All right, so you don't start with working before the main solution. So working number 1, let's go back to the question. Are we given number of units? Yes, we are given number of units. We are given demand. All right, so I will then say, first thing first, I need to determine, I will say years. We have years 1, year 2, year 3, year 4. Let me push it a little bit to the front. Year 3, year 2, and year 1. Okay, so units. Give me the unit for year 1.
The one is
20,000 units.
20,000 units. Year 2,
17,000.
70,000.
year 3,
125,000.
125.
Yes, sir.
Year 4,
20,000
20,000.
units.
20,000 units. So that's that. Then working number 1 now. I want to determine sales value. To get the sales value, first thing first, you need to get your selling price. Now, pay attention, please. Pay attention. This is the place where you are going to apply the concept of inflation. This is where you are going to apply the concept of inflation. You know, I told you that money cash flow for money cost of capital, real cash flow for real cost of capital. You cannot use money cost of capital for money cash flow, neither can you use real cost of capital for money cash flow. All right, apple for apple. This is the place for you to apply that. I will then go back to the question. I want to inflate selling price. Examiner has given us different selling price for the respective years. So if that is the case, selling price for the first year is 2,000. What's the selling price for the second year?
2,000.
2,200.
2,200. Year 3.
Followed by 1,600.
Year 4.
1,500.
1,500 is the selling price for year 3. You recall when I wanted to convert money cash, I said you can convert money cash flow to real cash flow or real cash flow to money cash flow. According to the question, let's go back to the question. You are told that selling price in current price terms. Selling price in current price terms. You know, I told you that when cash flow are stated in year one prices or first year prices, inflation should start from year two, isn't it? And I also said that when cash flow are stated in today's prices, year zero prices, or current value terms, inflation should start from year one. So in this question, the examiner has told you that selling price in current price terms. So if you also told that variable cost in current price terms, fixed cost in current price terms, that means all these cash flows are real cash flow, because real cash flows are cash flow that are stated in today's prices, year zero prices, current value terms, or first year prices. So you are told that selling price, variable cost, fixed cost are in current price terms. That means they are real cash flow. So if they are real cash flow, you want to convert it to money cash flow. To convert the real cash flow to money cash flow, what are you supposed to do? You compound, you increase your real cash flow to get the money cash flow equivalent. So I will then go to the question. This is selling price. So for the sell, I want to inflate the selling price. You are told that selling price inflation rates and fixed cost inflation rate are expected to be 5% per year. So inflation rate on selling price is 5%. I will then come here, inflation at 5%. So because this selling price is in current value terms, inflation should start from year one. So, and you know that you will recall, let me push it there. You will recall that I said if you want to convert real cash flow to money cash flow, that is, you want to make money cash flow the subject of the formula. It's supposed to be real cash flow multiplied by 1 plus inflation rate raised to power n. So now I told you that I don't usually make reference to this when I'm doing my calculation because it is implied in the question. I don't need to be using formula for anything. All right. So the real cash flow in this case is the selling price given to you in each year. Inflation rate is 5%. N will be for year one, year two, year three, and year four. So in this case, I would then say 1.05 because inflation rate is 5%. So 1 plus 5% will give us 1.05 raised to power 1. That's for year 1. 1.05 raised to power year 2. 1.05 raised to power year 3. 1.05 raised to power year 4. So that's what you need to do to inflate. Look up and pay attention, please. Now, to get our inflated selling price, you have to start from the inflation rate. So you say 1.05 raised to power 1 equal, sorry, I got it wrong something. 1.05, sorry, 1.05 raised to power 1 equal to 1.05, then multiply by 2,000. This will give us 2,100. So inflated selling price is 2,100. I will do the same thing for year 2. 1.05 raised to power raised to power 2 equal 1.10. Don't round anything. Put everything there in your, here is whatever you have, then multiply by 2,200. So we have 2426, rounding 2426. Here is 2426. Again, 1.05 raised to power 3 equal, I have 1.157626 multiplied by 1600 equal 1852. Here is 1852. Then for year 4, inflated selling price is 1.04, 1.05 raised to power 4 equal 1.21550626 multiplied by 1500. That's 1823, rounding 1823. So with this, I've inflated the selling price. This is inflated selling price. Let's say the number of units is A, selling price is B, then the sales value, sales in million, our figures are in million, will be equal to A multiplied by B. So in this case, I would then say 20,000 multiplied by 2,100. That's 42 million. So I will round it because our figures are in million. I will just write 42. All right. Next one, 70,000 multiplied by 2426 equal 169,820. When you round it, it will be 170 because figures are in million. Here will be 170. Next, 125,000 multiplied by 1852 equal 231,500,000. When you round it, that's 232 million. 232. The last one, 20,000. 20,000 multiplied by 1823. Okay. Equal 36,460,000. When you round it, that's 36. Okay, here will be 36. All right, so with this, we then go and post our sales value. Yes, Kemi, talk to me. What's your question?
Thank you, sir. I understand the selling price per unit is in real cash flow. I thought you said when you want to change from real cash flow to money cash flow, we are going to make M the subject of the formula. But like what we've done now, by inflating the selling price per unit, does that mean we've changed from real cash flow to money cash flow without using the Fisher's formula?
We are mixing it, Kemi. Okay, yeah, that's not what I told you. What we have done here is to just convert cash flows. We have converted real cash flow to money cash flow. You are not using any Fisher effect. You only use Fisher effect if you want to calculate money cost of capital, real cost of capital, right? So we are not calculating cost of capital yet. What we are doing is to just convert real cash flow to money cash flow. All right. And I told you to convert real cash flow to money cash flow, you are supposed to compound using this formula here. That's the formula I wrote up here. And I did the same formula I gave to you last week when I was explaining this. So when you convert real cash flow to money cash flow, you are supposed to compound. You are supposed to increase it because you want to inflate it. All right. And that's what we have done. The selling price given to you is in current price terms. That means they are real cash flow. So you want to convert that real cash flow to money cash flow. That's why we inflated it to from 2,000 naira. It has selling price has increased to 2,100 in year one. From 2,200, it has increased to 2,426. From 1,600, it has increased to 1,852. From 1,500, it has increased to 1,823. So we have inflated the selling price already. So to now get the sales, you multiply with number of units. That's what we have done so far. When we get to cost of capital, pardon?
Thank you. I've gotten it.
All right. It's okay then. So let's post. We have 42, 170, 232, then 36. Let's go and post in our table. 42 is the first year. You are going to call the numbers for me. Here is 42. The second year is 170. The third year is 232. I think please confirm the accuracy of the number. Then the fourth year is 30. What do we get? What's the fourth year cash flow?
36.
36 dash.
That-
So working number 1. I hope the year 2 and year 3 are correct.
Yes, sir.
Yes, sir. Yes, sir.
Okay then. So after sales value, in the question, we also have variable costs. So we need to go and do our workings for variable costs. So working number 2, variable cost. So variable cost per unit, according to the question, we are given variable cost per unit in current price terms to be 900, 1,000, then 1,020. The first year price is 900, 1,000, 1,020, 1,020. Again, inflation. What's the inflation rate for variable cost? According to the question, you are told that variable cost inflation is expected to be 4% per year. So here is 4%. Here will be 1.04 raised to power year 1, 1.04 raised to power year 2, 1.04 raised to power year 3, 1.04 raised to power year 4. We want to convert the real cash flow to money cash flow. So this will then be the inflated variable cost. Let's call this one C. Now, 1 point from your calculator, you start from the inflation, 1.04 raised to power 1, then multiply by 900, equal to 936. Here is 936. Next one, 1.04 raised to power 2 equal, multiply by 1,000. That's 1082. 1082, let me write that. Then year 3, 1.04 raised to power 3 equal, multiply by 1020 equal 1147. Year 4, 1.04 raised to power 4 equal, multiply by 1020 equal 1193. 1193. So with this, we have increased the variable cost. We have inflated the variable cost. So we now have money cash flow. So I need to calculate total variable cost. Our figures in million. So this will be A multiplied by C. All right. So units is 20,000 for the first year. So 20,000 units multiplied by 936 equal, that's 18,726. That's rounding 19 million. Next one, 1082 multiplied by the next units, which is 70,000. That's 75,740,000, 76 million, rounding. The third year, 1147 multiplied by units in year 3, which is 125,000. Multiplied by 125,000. That's 143,375,000. So rounding 143. And the 4th year, 1193 multiplied by units of year 4, which is 20,000, equal 23,860,000, rounding 24 million. So let's go and post. So you'll be calling the numbers for me. I have 19. I also have 76 for year 1 and 2. 1976. 1976. Here is 1976. Year 3, what do you have?
143.
143.
143.
143.
Year
And
4.
24. 24.
24. That's it. This is
24.
working number 2. So the next item is, we also have, according to the question, we also have fixed costs in current price time. Pay attention. This fixed cost, we are only going to consider it. Remember, when you are given fixed costs, we said that fixed costs are costs that have no sympathy for activity level, meaning that irrespective of production volume, fixed costs will not change. Provided fixed costs will not change, then the fixed cost is irrelevant. But if you are given incremental, direct, specific, or attributable fixed costs, we said they are all relevant fixed costs. So in this question, examiner has told you that there is a fixed cost of 10 million naira per annum. So this 10 million naira, I don't know whether it is relevant or not. I need to go back to the question. If examiner has mentioned fixed cost in additional information, so when you look at the paragraph after the table, where you have the inflation rate, examiner has told you that fixed costs represent incremental fixed production overhead, which are only attributable to the project, which means that this fixed cost of 10 million naira is attributable. It is incremental. That means it is relevant. So we have to account for it. Had it been examiner did not mention anything on the fixed cost, irrespective of whether you have inflation rate or not, just ignore it because it is not relevant. Only incremental, direct, attributable, or specific fixed costs are relevant. So in this one, this 10 million naira is relevant. So in this case, I don't need to stress myself. I don't need to go and be working for fixed costs because it doesn't have anything to do with number of units. I will just come here, fixed cost. Examiner call it attributable or incremental. Let's call our own incremental fixed cost. So the inflation rate on fixed cost we are told is 5%. Okay. So I don't need to go and do, if you do working for it, no problem. But again, I don't need it. So the first year, according to the question, you are given a fixed cost of 10 million naira. So 10 million naira, I need to inflate that. I would then say, where's my calculator? So 10, our figures are in millions. So 10 multiplied by 1.05 because inflation rate for fixed cost is 5%. So 1.05 multiplied by 10 will give us 10.5. Okay, this will give us 10.5. If we round it to whole number, that's 11. Whatever you have in your calculator, multiply by 1.05. That will give us 11.025. Again, you round it, that's 11. All right. Then whatever you have in your calculator, multiply by 1.05. We have 11.576. So when you round it, that will give you 12. What you have in your calculator, multiply by 1.05. Okay, 1.05. This will give us 12.15. So rounding, still the same thing as 12. Because I know some people will still ask me, how did I get my inflation, my fixed cost? Let me just go and do the working. Because at this level, you are upcomer. Huh? You are seen as upcomer. So I need to treat you like a baby, like you have. When you get to professional level, it's assumed that you understand it. So I don't need to be stressing myself at that level. But for now, let me do working for everything so that the question you are going to ask me will be minimal. All right. And also, those not in the class, it will be clearer to them. So this is incremental fixed cost. All right. So the fixed cost, let me do it as a primary school. Let me use primary school method. Here is 10, 10, 10, and 10. I would then say inflation at 5%. Here will be 1.051, 1.052, 1.053, 1.054. You can see, you can see it didn't take me 30 seconds. I've finished it, but this one I have to be doing step by step. It's a waste of time. That's what I said. It's not needed for, there's no need for you to be doing all those 111. So here will be the incremental fixed cost. Our figures in million. Okay. It has nothing to do with number of units. So you don't multiply fixed cost with number of units. So I would then say, bring out your calculator. 1.05 raised to power 1 equal whatever you have multiplied with 10. That will give us 10.5. 10.5 rounding is 11. I will go to year 2. 1.05 raised to power year 2 equal 1.1025 multiplied by 10. We got 11.025, rounding 11. Next one, 1.05 raised to power year 3 equal 1.157625 multiplied by 10 equal 11.57257625, rounding 12. The last one, 1.05 raised to power 4, raised to power year 4 equal 1.21550625, whatever you have multiplied by 10. We got 12.1550625, rounding 12. So that is how we got our the fixed cost that I've already done. Okay, you can see the method I use here is faster. All you need to do is to just say 1.05. Okay, you say 1.05 multiply by 10. The cash flow of year 1 is 10, so multiply by 10. So we got 10.5. We round it to 11. So that 10.5 multiplied by 1.05, we got 11.025. You round it to 11. Whatever you have multiplied by 1.05, all right, we got 11.57625. You round it to 12. Whatever you have in your calculator multiplied by 1.05, okay, this will give you 12.1550625. You rounded it to 12. That's it. That's it. So that method is faster. Instead of doing working, it's a waste of time. Now that we have calculated incremental fixed cost, I need to go back to the question and check in case I have other cash flows. Do you have other cash flows? Yes. Examiner has given you production equipment for the new device will cost 120 million. That's the initial outlay. We are also told that additional initial investment of 20 million will be needed for working capital. That's working capital. We are coming back to that. Then, when you look at the first paragraph of the question, examiner has told you that 8 million naira has been spent in developing and testing the device over the past year. That 8 million naira is irrelevant because it's a sunk cost. All right. Development cost is an example of a sunk cost. Therefore, you ignore it. Also, initial market research has been conducted at a cost of 2.5 million naira and is due to be paid shortly. Again, the market research is an example of sunk costs. It's not relevant. The 2.5 million naira is not relevant. So both the 8 million and the 2.5 million naira for development cost and market research cost are irrelevant. They are sunk costs because they are not relevant. Okay, so that is as per that. Then let's continue with our calculation. Since there is no other relevant cash flow, let's determine the profits. So 42,000 minus 30, this will give us positive 12. Here is dash. All right. 170 minus 87. We got 83. Next, 232 minus 155.
77.
That's 77 profits. Then after that, 36 minus 36 will give us 0. Okay, then we have dash. So this is profits. This is profits. You remember we are following a format. Immediately after profit, you are supposed to pay tax. The company tax rate is 30% according to the question. An examiner has told us that tax is paid 1 year in arrears, which means that the profit of year 1 will be taxed in year 2. Therefore, to do this, I want to calculate my tax liability. The profit of year 1, which is 12, multiplied by 30%. So I'm supposed to pay tax of 3.6 million. So 3.6, when you round it, that will be 4. So I will not put it down in year 1 because tax is paid 1 year in arrears. Profit of year 1 will be taxed in year 2. Profit of year 2 will be taxed in year 3. Profit of year 3 will be taxed in year 4. Profit of year 4 will be taxed in year 5. That is 1 year in arrears. So in this case, I will then say, of course, I got 3.6. That's rounding 4. Put it in brackets because it has liability, cash outflow. Then the profit of year 2 of 83 million multiplied by interest rate of 30%. That's 24.9, rounding 25. So profit of year 2 will be taxed in year 3. Here is 25. Also, profit of year 3 of 77 multiplied by 0.3. That's 23.1, rounding 23. Okay. Then profit of year 4. In year 4, we have 0, so you put a dash. All right, we put a dash because we rounded our number, so no worries. So we put a dash. Then after tax, I need to calculate tax saved on capital allowance. So I will say tax saved on capital allowance. So let's go and calculate our capital allowance. Working number 4. You see the way we are taking it step by step. That's what is expected of you. Number 4, I want to calculate tax saved on capital allowance. Okay. To do this, you use this formats, starting from, of course, create a column for year, narration, the costs of the assets, then tax saved. on capital allowance. Company tax rate is 30%. Our figures are in millions. If you want to restrict your number to thousands, so just be consistent. Okay? So we have year 0. We then go back to the question, what's the cost of this equipment? According to the question, you are told that the production equipment for the new device would cost 120 million naira. Okay, so the cost of the equipment is 120 million. All right, so here is 120. Our figures are in million. I don't need to, I've already put it on top. So in year 1, the company will claim capital allowance. In year 1, you can have initial allowance and annual allowance. In this question, we are not given initial allowance, so it has to be annual allowance. So what's the annual allowance rate? The examiner said that you should do tax allowable depreciation of 25% on reducing balance basis. So 25%. So I would then say annual allowance at 25%. So 120 million multiplied by 120 multiplied by 25%, 0.25 equal 30. Here is 30. 30 minus 120 will give us 90. This is tax written down value at the end of year 1. I will then move to year 2. Annual allowance at 25% of 90. What do you have there? 25% of 90. 0.25 multiplied by 90 equal 22.5. So you round your number, you have to be consistent since we are rounding all our numbers, whole number. So here will be 23. At times, examiner may be specific that you should round your number to 1 decimal point, 2 decimal point, or whole number. Where examiner is silent, you are at liberty to do it anyhow you like. So here will be 67 difference. So this is tax written down value at the end of year 2. Remember, the useful life of this equipment is 4 years. So we are moving to year 3. Annual allowance at 25% of 67. Okay. 67 multiplied by 0.25 equal 16.75. That's 17 rounding. So this will give us 50. This is tax written down value at the end of year 3. Remember, the useful life of this asset is 4 years. At the final year, year 4 is the final year. You need to compare the written down value with the sales proceed, whether it will result in balancing allowance or balancing charge. So I will then come here, being the last one, I will then put the sales proceed. Sales proceed is the same thing as scrap value. Let me just put it as sales proceed. So how much is this equipment being sold? Let's go and check. Are we given? Yes, we are told that the equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. Okay, the disposal value of the equipment is 10 million naira. So here will be 10. Less. So the difference is 40. Because the tax written down value of year 3 of 50 million is higher than the sales proceed, then the difference is called balancing allowance. This is balancing allowance. Okay, in year 4. So I want to use tax saved on capital allowance to reduce my tax liability. So to get my tax saved is calculated as capital allowance multiplied by the company tax rates. Okay, tax saved on capital allowance is computed as capital allowance multiplied by company tax rate. So in year 1, capital allowance is 30 million multiplied by 30%. Equal to 9. Here is 9. Then Year 2 capital allowance is 23. 23 multiplied by 30% equal 6.9. So here we'll be rounding, that's 7. Year 3, tax saved. Capital allowance is 17 multiplied by 30% tax rates. That's 5.1. Here will be 5. Then the last one, balancing allowance of 40 multiplied by 0.3, 30%. That's 12. When you add up the capital allowance, the tax saved, the tax saved cannot be more than the capital allowance claimable. Therefore, 12 plus 9. So the total capital allowance claimable supposed to be 39. Sorry, supposed to be 33. Okay. So total tax saved. Total tax saved is 33. So you need to confirm if you have not claimed more than the capital allowance you are supposed to claim. To do this, I would then say total tax saved is equal to the cost minus scrap value multiplied by company tax rates. This one has nothing to do with your calculation. It's just to show that you have not claimed beyond the capital allowance you are supposed to claim. Here is 120 million. Scrap value is 10 million. Company tax rate is equal to 30%. So 90, 110, 110 multiplied by 0.3. So 33 million. Here is 33. It means that what we have done is correct. So the two of them must be equal. All right. So we have not claimed beyond the capital allowance claimable. So in this case, I need to go and post my tax saved on the capital allowance. The first year is 9, second year is 7. So I have 97512. 97512. You see the way we are pushing. That's what is expected of you on that day. Okay, 9, 7, 12. No, 97512, I think. 975, then 12. Is it equal to 33? 16, 21. Yes, 33. That's it. Now, like I mentioned, your tax saved on capital allowance must follow the pattern of your tax liability. If your tax liability is in the current year, your tax saved on capital allowance must also be in the current year. If your tax liability is in arrears, your tax saved on capital allowance must also be in arrears. In this question, tax liability is in arrears. Therefore, here will be 9, 7, 5, then 12. Working number 4. All right. Then after the tax saved, we are following the format. After tax saved, we have sales proceed or scrap value. So according to the question, the sales proceed in year 4 is I think is 10 million. Yeah, it's 10 million. Then we have initial outlay. Initial outlay is 120 million. Okay. Then we also have working capital. Working capital. Kemi, you are the one that asked for working capital the other time, so you need to pay extra attention so that you understand how we are going to treat it. So I will then go back to the question, how am I going to treat this working capital? Examiner has told us that, and when you go to the last paragraph of the question, you are told that in the first sentence, you are told that the production equipment for the new device will cost 120 million naira and an additional initial investment of 20 million naira will be needed for working capital. So you have been given a one-off working capital of 20 million naira. That's one. Then the examiner is now telling you that, okay, this working capital of 20 million naira, the average general level of inflation is expected to be 3% per year, and working capital will experience inflation at this level, which means that examiner is asking you to inflate your working capital by 3%. Okay, you are expected to inflate your working capital by 3%. So that's that. Let's go and do working for our working capital. First thing first, you see that examiner did not tell you that this working capital of 20 million naira is in current price terms. So you are told that an additional initial investment of 20 million naira will be needed for working capital. When do you need this working capital? Of course, it's assumed that this working capital will be, examiner has told us, per year. If your inflation is 3% per year, that means this working capital of 20 million naira is the first year price. So if it's the first year price, then you need to start inflation from year 2. This is what I'm saying. Let me show you. Let's go back to our workings. All right. Your journey to become a chartered accountant has just begun. Okay. So that's that. This is working number 5. Working number 5, I want to calculate working capital. Working capital. Okay, so I have year 1. Let me push it to the front a little bit. Year 1, year 2, year 3, year 4. Then I have total. All right, so we have working capital of 20 million naira for year 1. And I said that, of course, inflation rate is 3%. All right, inflation rate is 3%. Let me show you another method of 3%. Here is 3%. Now, 20 million naira is the first year price because this working capital will be needed in the first year. So that's 20 million naira. And you are told that it will increase by 3% per annum. So because this 20 million naira is first year price, you are not going to inflate that year 1. Inflation will start from year 2. But the fact that I said inflation will start from year 2 does not mean that year 2 will now be raised to power 2. No, it will be raised to power 1. In fact, let me use primary school method so that you understand better. Let me use primary school method. So here will then be 20, 20, 20. So inflation now. Inflation at 3%. So 1.03 raised to power 0 because it's in first year price. This working capital of 20 million naira that's the first year price. So here will be 1.03 raised to power 1, 1.03 raised to power 2, 1.03 raised to power 3. This is what I was saying, that the fact that your working capital is in first year price does not mean, and I said that inflation should start from year 2. The fact that I say inflation should start from year 2 does not mean that you are then going to say 1.03 raised to power 2. No. So you have to do the way I've done it right now. So this will then be the working capital, inflated working capital. So for the first year, 1.03 raised to power 0 multiplied by 20 will still be 20. Anything raised to power 0 is 1. 1 multiplied by 20 is 20. Now, the second year, 1.03 raised to power 1 equal multiplied by 20 equal to 20.6, rounding 21. Okay. Then for year 3, 1.03 raised to power 2 equal multiply by 20 equal 21.2, okay, which is rounding also. I will say the same 21, even though there is an increase because it's a rounding. So the next one, 1.03 raised to power 3 equal, then multiply by 20 equal 21.85, rounding 22, okay, 22. So let's do it this way because we have hidden some numbers inside these numbers, okay, because the first one is 21.0 something something. However, uh, of course, you can see that your working capital has increased from 20 to 22. All right, from 20 to 22. So because if I'm to do 21 minus 21, it will be equal to 0. So let's restrict it to one decimal place. Let's restrict our working capital to one decimal place so that the hidden numbers will be made open. So let me do it again. From the second year, 1.03 raised to power 1 equal, then multiply by 20. That's 20.6. So let's call this one 20.6. Then the third year, 1.03 raised to power 2 equal, multiply by 20.
21.2.
21.2. Then the final one, which is 1.03 raised to power 3 equal, multiply by 20 equal 21.85. That's 21.9. All right, let's make this one 21.9. Okay, you will notice that our working capital has increased from 20 in the first year to 21.9 in the fourth year. So the next you need to do is to find the incremental working capital. I will then say incremental working capital. The first year is 20. 20 has increased to 20.6 by 0.6, right? Then 20.6 has increased to 21.2 by 0.6. Also, 21.2 has increased to 21.9 by 0.7. So when you add up everything together, you must have a total of 21.9. This should be 21.9. Let me confirm. Okay. 20 plus 1.2 plus 0.7. Yes, that's 21.9. That's it. That's it. So at this point, the rule says that working capital should be treated as a cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. So what that simply means is that I can then come here and I will say relevant year. The working capital of year 1 of 20 million should be treated as cash outflow. Year before year 1 is year 0. The one of 0.6 in year 2 should be treated as cash outflow in the year before year 2, which is year 1. The one of year 3 of 0.6 should be treated as cash outflow in the year before year 3, which is year 2. The one of 0.7 should be treated as cash outflow in year 3. Then at the end of the useful life of 4 years, we recover the entire working capital. So everything has nil off. Okay, so that is as per that. Yes, Rose Simon, talk to me. What's your question? Rose?
Thank you,
raised
sir.
Yeah.
Yes. My question is, I didn't get how for year 3 how you got that 0.6, which is the incremental working capital. How you got
20
that
point,
figure?
20.6 minus 21.2, that's 0.6.
Okay. Then 20. I don't know how it's going on. Because I was
The
comparing. Okay. Please just explain that line.
I said 20 minus 20.6, you get a difference of 0.6.
Okay.
20.6 minus 21.2, you get 0.6. 21.2 minus 21.9, you get 0.9, 0.7
Okay.
difference. Yeah.
Okay. Thank you.
Yes, Kemi, what's your question?
Sir, please help me scroll to where we calculated capital allowance. I'm so sorry, sir. Sir,
This is it.
what if the balance we are having? What if it is not a balancing allowance? What if it's a balancing charge?
You put it in brackets.
Okay, sir.
All right. So let's go and post. Yes, the first one is year 0, here is 20. 0.6, 0.6, then 0.7. Year 4, we recover 21.9. This is working number 5. So at this point, we need to determine the net cash flow. Here will be 140. So let's do it together. 12 minus 0.6, that's 11.4, right? This is the net cash flow. So 12 minus 0.6, that's 11.4. 12 minus 0.6. So 11.4, if you like, you can round it here. So which is 11. You can round your number to 11. Okay. Then 83 minus 4 plus 9 equal 88. 88 minus 0.6 equal 87.4. So we can round it to 87. Then 77 minus 25 plus uh plus 7 minus 0.7 equal 58.3. You can round it to 58. Then the year 4, 23 minus 23 minus 23, 23 minus, then plus 15 plus 21.9 equal 13.9, round it to 14. Then here is 12. That's it. Now pay attention here, please. So we have discount factor at, I will then go to the question. I need to go and pick the cost of capital given to me. Now that I want to discount the cash flow, you have to give apple for apple. We have calculated money cash flow and you have to use real cost of capital. Again, Kemi, you have to pay attention here. You asked the question the other time. When you look at the last paragraph in the question, the examiner told you that Washington PSC has a real cost of capital of 7.8%. So because the cash flow that you have calculated are money cash flow, you cannot use real cost of capital to discount money cash flow. So you need to convert the real cost of capital to money cost of capital using Fisher effect formula. So let's go and calculate money cost of capital. Okay. Working number 6. Oh, okay. I don't have space again. Let me see. Let me see. Let me just come here. Working number 6. I want to calculate money cost of capital. Who is that person? Victor among something. You are the ones writing on my screen. All right. Money cost of capital. Why are we calculating money cost of capital? Because the cash we have calculated money cash flow. An examiner has given you real cost of capital. You cannot use real cost of capital for money cash flow. So we need to convert real cost of capital to money cost of capital using Fisher effect formula. So in this case, the formula for money cost of capital is M is equal to 1 plus real cost of capital multiplied by 1 plus general inflation rate, all minus 1. This is the formula I gave to you last week for calculating money cost of capital. Therefore, M is equal to, the real cost of capital is 7.8%. So that will plus 1, that will give us 1.078 multiplied by 1 plus general inflation rate. According to this question, general inflation rate is 3%. So 1.03. 1 plus 3% will give us 1.03, all minus 1. So put it in your calculator, give me the final answer. So here will be 1.078 multiplied by 1.03 equal, then minus 1 equal, multiplied by 100% equal to 11.034. This is 11%, approximately 11%. Money cost of capital is approximately 11%. So if that is the case, let's go and discount our cash flows. You can see it's not a child's play. All right, so here is 11%. Okay, so discount factor at year 0 is 1. Then 11% for year 1. So that will be 1.11 raised to power 1 minus equal. I have 901.901, 0.901. Then discount factor for year 2, 1.11 raised to power 2 minus equal 812, 0.812. Year 3 will be 0.7 watts.
731.
731. Year 4, 0.6.
59.
59. Year 5, 0.6.
593.
Pardon?
593.
593. So we didn't get the present value. So here will be 140. Present value. Okay, so 11 multiplied by 0.901 equal 9.9. So rounding.
9.911.
So rounding is 10.
Okay.
Then next one is 87 multiplied by 0.812 equal 70.6, rounding 71. Okay, then year 3, 58 multiplied by 0.731 equal 42.39, rounding 42. Then year 4, 14 multiplied by 0.659 equal 9.226, rounding 9. Year 5, 12 multiplied by 0.659. multiply by 0.593, rather. 593 equal 7.116, rounding 7. So at this point, I will just calculate my NPV. To get the net present value, FM is not difficult. It's just about formula. Once you understand the formula, you are good to go. Now, we said NPV is the difference between the present value of cash inflow and present value of cash outflow. Therefore, first thing first, let's add up the positive present value. I have 81 plus 51, then 58. Sorry, error. 81 plus 58. I have 139. 139 minus 140, negative 1. Okay, negative 1 million is the NPV. That means the project is not financially viable. All right, negative 1. Though, if you use 1,000, because we have rounded the numbers, that's why we're having this negative. Ordinarily, it's supposed to be positive. For those of you that have my golden book, you see that the answer you have there, the figures there are in thousands. I think, yes, they're in thousands, and you have about 955 or thereabout positive NPV. But because we've rounded some figures, and that's why what's supposed to accumulate to the 955 has not turned to negative. All right. So that is it. This is how to calculate the net present value. If you are not too comfortable with this kind of approach, by rounding your number to odd numbers or to millions, if you like, you can decide to do thousands. If you like, of course, you can write it out in full because you don't have space. So you can restrict your number to thousands, or you restrict your number to 2 decimal points or 1 decimal point, whatever it is. Just know what you are doing, and you have to be consistent all throughout. Okay, so that is the NPV. Now, examiner is, of course, this is where we are going to call it a day. In our next class, we are going to calculate internal rate of return, discounted payback period. Then we advise. Although, if I don't know if you can spare me additional 15 minutes, we'll be done. But if not, we can push it to our next class. All right. So can you give me additional 15 minutes to complete the question, or we can close the class? Talk to me.
Yes, let's continue.
Yes. So that's from Ruth. Any other person? I need 3 people.
Let's close
Yes.
the class.
Pardon?
Let's close the
Let's
class.
close the class.
Let's close the class.
Okay. All right then. So if that is the
Let's close
case,
the class.
all right then.
We are
Okay.
full
So I'm the one that's supposed to be complaining. I've done like 3 classes today, back and forth, and I have to continue online, so it's what it is. We are used to it.
You're born with
Yes.
safe calculations.
Pardon?
I said you are born with all the calculations, PM, FM, and the likes.
Yes. So, all right. So, yes, that will be the end of today's class. Let me know if you have any question for me. How do we get us? Of course, it will be shared now. It will be shared. It will be shared. All right. So any question for me so that we can close the class? I understand. It's already after 11. Okay. All right then. So in the absence of no further question, I want to say thank you for waiting behind. We continue next time by the grace of God, when we shall be doing internal rate of return, discounted payback period, then we advise according to the question. Then we have 2 more additional illustration, and that will be the end of capital budgeting. Yeah, thank you once again. Good night, everyone.
Thank you, Mr.
Thank you,
Akola.
sir. Good night, sir.
It's a pleasure.
Yeah, welcome. This is Adejuwan.
Mr. Adejuwan, thank you very much.
Yeah, welcome.